And if you have questions, and if there are any questions, please feel free to put them in chat, or we will also do them at the end as well.
And if you don't mind me hopping in real quick, Peter, if all of the attendees don't mind opening the chat box and switching the to all panelists and attendees, you are welcome to go ahead and introduce yourselves just to give everyone an idea of who's in the room, your name, who you're with, your title, all that good information. And with that, you can take it away, Peter.
Thanks, Gary. Can you see my slide here?
Yes, I can.
Okay, excellent. And I'll try to check the chat every once in a while, but I might miss something, of course. So it's great to be with you all. I really appreciate the Williamsburg business community a lot. My new favorite sweater I bought on Merchant Square right over there. And I get greeted by name when I go to buy coffee downtown. So a lot of great things. And thanks for introducing everybody. It's good to see folks here and whom you represent. That's excellent. So as you heard, I am a labor economist, and when you all asked me to come talk about business outlook, I was a little nervous. I thought, oh gosh, I don't really do economic forecasts, and I don't know as much about Williamsburg business as you all do, but I do study a lot about work and pay, and I've been thinking hard about some things, mostly at a national level. And so I'm going to try to bring that down as locally as I can, given the data that I have. But I thought that a couple of things that are on people's minds that I, talk with people about are inflation is a big thing, a big deal we talk about a lot. I was talking to my dad about it yesterday, and worker shortages. So I've talked to local folks. Even when I'm buying coffee, is it easy or hard to hire people to work? And it hasn't been very easy, right? So those are things kind of in my wheelhouse, and I'm going to talk about them a bit, but definitely appreciate your questions. And so please bring them on, and I'll be kind of teacher-like and talk about some of the theory as well. So that's how we'll proceed. So the two things I want to talk about: inflation first, and just a little bit of data to share and make sure we're all on the same page. So what I did here is show you a pretty broad span of history. So going back to around 1950, this is annual inflation in the United States. So inflation is just a general increase in prices. So on average, prices for bread and milk and also legal services and lots of other things are increasing. That's what inflation means. And so if you look back 1950s, there was a year, and this is one year where the inflation rate, all prices on average, rose about 9%. A lot of inflation in the 1970s, as a lot of folks know and remember. And then we've had this low and stable price increases since, Paul Volcker killed inflation in the early 1980s, basically. So this was he was the chair of the Federal Reserve. And so this period here we usually refer to as the Great Moderation in economic history, where prices were pretty moderately rising. In fact, you could argue that we had not enough inflation in this era around here. And then we see this big increase. Inflation prices are increasing quite a bit. And so in February, we got a new report on price increases, about 7-8% across the board, which is a lot. And something that we're quite concerned about. So we want to talk about that a bit. This graph just shows a little bit of historical perspective. This is precedented, but it's really big and something that we haven't seen since several decades. So more recently, if we look at just month-to-month changes in prices, this is what we see. And so before the COVID recession, we had small price increases, pretty stable. And then price decreases when we had just a major short recession. And then prices have increased over here, bounced around a little bit, and monthly price increases in the past several months have been quite large, bouncing around a little bit, not obviously increasing at an increasing rate, but still elevated and something that we want to be concerned about. So why do we have inflation? What's going on? And should we be worried about it? This is something that I think no one really knows the perfect answer to this question. If you talk to someone who has lots and lots of confidence about exactly what's going on and what's going to come. I would recommend that you maybe listen to someone else because there's a lot of uncertainty about this, and folks who know a lot about it are, you know, a lot more than I do for sure, arguing about it. But basically, there are two big candidate explanations for why prices are rising that I think are helpful for putting things into perspective. And number one is the sort of good news. There's a really obvious reason that prices have risen over the past year and 2 years, and it's COVID has disrupted lots and lots of things. There have been lots and lots of supply chain disruptions that typically leads to increases in prices. And that's hard at the time, but not necessarily going to stick around. The second candidate explanation is that people just expect prices to rise in the future, and so they just raise their prices. Say if you have a restaurant, you're setting the menu, you just make the price of a hamburger higher than it was, because all prices, you just expect prices to increase. When people expect high prices and price in higher prices, that just leads to more expectations, and you've got a self-fulfilling prophecy. So that could be bad. So basically, when I think about these things, the candidate explanations, what's going on, what's primarily driving inflation these days. If it's supply chain disruptions, I think that's temporary and annoying, but not scary, not that big a deal. It's probably going to go away pretty fast as supply chain disruptions smooth out, which we think they probably will. If what's going on is mostly about expectations of increasing prices, we've just baked them into what we think the world will look like in a couple of years, well, that's a problem. And inflation can get out of hand, has in the past gotten out of hand, although it's been a long time. And so we're kind of worried about that. So I'm not really totally complacent. I'm not super scared, but we want to think about these things when we think about inflation. So just go back to the Econ 101 classroom a little bit and think through what I mean by this supply chain disruption kind of idea. So this is what I teach my students, super helpful framework for understanding how prices are set in a market. So you have the supply of goods or services. This is what business owners basically do. And so if you have a market, for example, I love thinking about the market for coffee because I like coffee and I participate in this market daily. When prices go up, you tend to see the quantity of things offered for sale go up because it's more profitable to supply coffee, right? So if the price of coffee is just going up in the market, people who supply coffee are going to think, hey, I want to keep my store open more hours. I want to hire more staff to get more coffee sold because it's a more profitable thing. So prices and quantities go in the same direction when we think about the supply of things. But of course, customers matter too. And so there's this demand relationship, and customers don't like high prices, of course, they like lower prices. And so when the price rises to customers, the demand relationship tells us that the quantity demand goes the other way, right? So when the price of coffee goes up, I'm going to buy 1 cup instead of 2. And so that's the demand side. We put these things together and we get a market, and eventually prices move up or down until they reach a steady, stable sort of point that we call equilibrium. At this price, P0, the quantity supplied is here, and the quantity demanded is also here. And so we don't have a surplus, we don't have a shortage, we just have whatever quantity cups of coffee it is at this price. Now, if the supply chain gets disrupted, coffee gets super expensive, or I can't hire enough workers to keep my store open or something like that, then we just have less supply and this whole curve shifts and we tend to see that prices will rise. If prices didn't rise and I just stayed at this P0, then the quantity supplied, say of cups of coffee, would be much smaller than the quantity demanded, say of cups of coffee. You need to have a whole lot of people who are really upset and say, hey, I want more coffee. And it's not available to me at this price P0. And a lot of them are willing to pay more than P0. And people selling coffee say, well, that's great. We'll charge more, we'll make more money, and that's good to cover the increasing cost of coffee or whatever it is. And so we see this rise in prices, and that's going to increase the quantity supplied. It's going to decrease the quantity demanded until we get in a new equilibrium. And so when I say supply chain disruptions, leading to price increases, this is the kind of thing that I'm talking about. Basically, we know that workers at factories all over the world got sick and slowed down production. We know that ships slowed down and the docks, workers worked less fast because people didn't show up to work because they were sick or whatever. And so supply chain disruptions caused this kind of price increase. As those things smooth out, we should see this supply curve kind of shift back to the right, moderation of prices. Another thing that I didn't show on this graph is that when we were all stuck at home buying a lot of goods rather than services, I didn't get my hair cut quite as often, but I did buy more, things around the house, or, gardening supplies, because everybody was in their backyard making their gardens look beautiful, lumber, because everybody was getting their house renovated or remodeled, or a fire pit in the backyard, whatever it was. We were increasing the demand of goods, but not so much of services. And so the prices of goods went up. The prices of services didn't really go down. Price of a haircut didn't fall. And so on average, goods prices pulled up all overall prices, and we got a lot of inflation. So that's not that big a deal. The big deal with inflation is if we are expecting more inflation and we preemptively increase our prices, then everybody looks around and says, oh, they're increasing their prices, I want to increase my prices. Then we all increase our prices. Then we get worried about things, and that leads us to increase prices more. And it's like a train left the station kind of going downhill, and it's out of control. And that's what gets people worried. The most recent look at price increases showed some price increases in the service industry that isn't quite consistent with just this supply chain disruption idea. And so we want to be cautious, considerate of that kind of thing. And so just to summarize what I'm talking about with inflation, prices have increased, and there are some pretty relatively simple explanations for why some of that has happened, but we should also be concerned that this might turn into a long-term kind of problem. There are a lot of things written, a lot of things we could talk about. I'd be happy to answer questions about it to the extent that I can. One of the things that gives me a little bit of hope and some comfort is that the Federal Reserve is our central bank and has a really good history of dealing with these kinds of issues quite well. I know people there, they're experts, and they do good work. And so they have lots of information and are ready to address inflation in the best ways. They're dealing with a lot of uncertainty. It's a very hard job. They're not going to get it perfectly right 100%, but they'll do pretty well. And if you look at professional forecasters, I'm not one of them, but they are suggesting that the inflation rate should moderate some in the future. So I'm very reluctant to make a forecast myself or a prediction because I don't have a crystal ball, and I don't have a good history of making predictions, even to my close friends I've shared things with. But that's sort of the professional take, I think. So that's what I wanted to share with inflation. Maybe it'd be helpful just to keep going. Does that make sense, Yuri? And we can take questions later on. If I were in class, I would say any questions about that. But I'm guessing that this is a slightly different environment. So I'll just talk about.
Like we actually have a question that has.
Oh, let's do it, Yuri. Let's talk.
Perfect. Councilman Maslin, thank you for asking. He said, please explain the bundle of goods which make up the CPI index, and how do we track other inflation factors such as rent and real estate taxes?
Yeah, great questions. Thanks. The bundle of goods is defined by the Bureau of Labor Statistics, which is the government agency that calculates price changes. I should say it's one of the agencies that calculates price changes. We also have the personal consumption expenditures deflator and other stuff like that. But the government agency says, what's a bundle of goods that we can track over time? And I think the thing to say, the potentially surprising thing, is that this is a very big group of things that are very detailed and specific. So a loaf of bread really is there. A gallon of milk really is there. But, a haircut is part of the bundle. The the price of legal services would be part of the bundle. Electronics, specific electronic goods would be part of the bundle. And rental prices make up a third or so of a lot of people's household spending. So the price of rents or of housing get included, certainly. And one of the biggest, most important parts of inflation calculations and price indexes. These are all weighted by what share of expenditures they represent in people's budgets. So rent would be huge. The cost of owning your house is imputed based on the use value that we get from rents. So there should be some relationship between the price of renting a residence for a month and basically what I'm giving up. It's called an opportunity cost. So I own my house, but I use it, and there's a cost of that because I'm not renting it out to someone else, which is something that I could do. And so the rental price is the cost to me of using my house rather than renting it out. So you've also asked about real estate taxes. I'm not 100% sure how taxes get included into the price indexes. So certainly if they if we raise taxes on rental properties and prices increase as a result of that, which is something that we would expect, that would get calculated in. But I don't think taxes themselves are directly reported in a price index. So there's another question I see. Can I go ahead and answer it, Yuri?
Would help if I unmuted myself. Please do, if you could just read the question to some degree so that the audience knows what the question is.
Right, everybody's good. Everybody's not looking at the chat. Great, so Tucker Edmonds, thanks. If the Fed raises rates, that should increase production costs due to higher interest expense, which in turn should raise consumer prices. So how does raising rates help stem inflation? Okay, good. So there are a variety of things that happen when the central bank does things to nudge interest rates higher. On net, when you add up the positive effect of this and the negative effect of that, we expect that raising interest rates will reduce economic activity enough to actually slow down price increases. So the inflation rate would come down if the Federal Reserve increased interest rates. And so why is that? One way that works that we expect is through investments. So if I can borrow money at a very low interest rate, this is a very attractive thing for me. And so I'm going to go ahead and borrow money, go into debt to engage in some economic activity right now. And that economic activity increases demand for something and increases gross domestic product and increases prices. That's with low interest rates. If we raise interest rates, then investing, borrowing money and doing something today and paying for it later is less attractive. And so that's going to put, take the foot off the gas pedal of economic growth and demand, and it's going to tend to reduce prices, or at least if it doesn't reduce prices, slow the increase of prices. So that's one of the ways. You could see it in housing as well. So when interest rates are super low, people want to get mortgages and buy houses, and so house prices go up. When interest rates rise some, we take the foot off the gas a little bit, and so there's a little bit less demand for housing, and prices go down just a bit, and so rents would go down as well. So that's the way we usually think about that relationship. Let's see. So I see another question. With the increase in operating costs for companies, labor, materials, etc., what's your opinion on the inflation we're seeing now becoming the new normal, meaning we will not see a correction or significant deflation in the market? Yeah, this is a great question. So there's a distinction between the level of pricing and the increase in pricing. So inflation is really a rate of increase from whatever level you find yourself in. And so I would not expect a lot of prices to go down like a deflation generally to correct for the past year's inflation, I would expect that the inflation rate would slow down. And so if the price of a cup of coffee went up from $2 to $2.20, that's a big 10% increase. I wouldn't expect it to go back to $2, but to slowly increase, or the rate of increase to slow down. And usually the price level, this is something that's kind of awkward for economists because we think differently about prices than a lot of folks do. And in an economic model where we live, a lot of times, the price level doesn't matter all that much, right? If my income goes up 10% and all the prices that I pay for stuff go up 10%, I'm pretty much the same off as if they hadn't increased at all. And so if we just stay at a high level, but all prices adjust, everybody gets higher wages and higher revenues for their businesses because prices are higher just the same, then it shouldn't be a big deal. There are some, things that would be affected, but the new normal should be just about the same as the old normal. It's the change that really bothers us, right? So when the price increases and my income didn't go up, then I'm worse off, and that's really bad. And so when we're fully adjusted, we don't really need to have a deflation to get back to normal. The new normal should be pretty much okay, or at least not as scary as the change to the new normal was. I hope that helps. So. But some prices really do go down. The price of my phone is actually much lower than it was 10 years ago because this thing is so much better than what I could get 10 years ago. And so maybe it's 20% more expensive than my 10 years ago phone was, but it's 50% better as a product. And so the price per calculation or whatever my phone does is much lower than it used to be. All right, I don't see other questions in the chat. Yuri, do you have a private channel that I don't see?
No, I think you've covered everything that's been dropped in the chat so far. As Peter continues, please feel free to continue dropping those questions in the chat box and we will get to them at the end. But for now, we can go on ahead and move forward.
All right, so topic number 2, I wanted to talk about hiring and worker shortages, things like that. So this really is more my wheelhouse because I'm a labor economist. I study workers and pay and compensation. So we talked a little bit about a market and how I think about supply and demand in a market. The labor market is the most important market, at least in my biased mind, but I think it matters for a lot of us because it's the market where we get most of our earnings, most of the income that we use to buy things. And so a labor market uses, or the model of a labor market, we use similar tools to the model for coffee, right? We just kind of reverse some of the roles a little bit. So instead of just a general price of coffee, we think of the price as the wage. So this is, $14 an hour is my wage rate. That's a price of labor services. And instead of the number of cups of coffee, we're talking about employment. So the number of hours that people work or the number of jobs available is the quantity here. And the suppliers in the labor market are folks like me. I supply my work in the higher education teachers market or the economists market. And the higher the wage in that market, the more people who want to do what I do. And if the wage is low, fewer people want to do that. So supply is really all about workers in this model, individual people usually. The demand for labor here is, we usually think about as businesses. William & Mary is a demander for labor because they pay me to do my job. Many of the folks in the room are working at businesses and you're demanding labor. I was a labor demander when my kids were tiny and we hired a nanny to watch them at home. And so I actually have an employer identification number, an EIN, and I have paid all of the unemployment insurance taxes because I was doing it as an employer, as labor demander, right? But what's the relationship here? As wages go up, firms want to hire fewer workers. So I would rather buy a robot than a worker as wages go up, right? Or maybe I have to close my business or slow it down because workers are so expensive and I hire fewer workers. And so that's the demand. And we get this equilibrium here where wage levels need to be set around the place where the same number of people want to work as the same number of firms want to hire workers. Because if wages are different, then we'll be out of equilibrium. We'll have a big glut of workers or a big shortage of workers. And so we can think about a worker shortage in this kind of framework in this way. So just like before with a supply chain disruption, imagine a reason that you have much less supply than you had before. And so this means, given some wage rate that we used to see being in equilibrium, now you just have a lot fewer people who are willing to work at that wage rate. And what we call this is a shortage. This part of the horizontal axis here is the difference between the number of jobs at this wage rate and the number of people who are willing to work these jobs at this wage rate. And so you might think of this as job openings, job ads, many of them. This is signs saying now hiring, and workers not really showing up for them. And so in equilibrium, what we'd expect is, just like before, the price will rise, right? So as firms are really competing for the scarce workers in the economy, they're going to have to compete by raising the wage, making this a more attractive job to workers. And that's going to pull more workers in. And it's also going to reduce the number of jobs available, probably, until we meet somewhere in the middle and we have a higher wage rate and we don't have a shortage anymore. So we're clearing the shortage in the market. That's what we tend to expect to see. And so do we see, looking around Williamsburg and elsewhere, something that looks like a labor shortage? And I think, yeah, it may be so, that's being cleared. And so, we know that hiring has been difficult. This is my super quick history of labor markets the past couple of years. Before the pandemic in 2019, we had a pretty tight labor market, but it was quite productive. Workers wanted to work, firms wanted to hire them, wages were rising, but there wasn't really a shortage. It was just healthy, things were pretty good. And then in March, April 2020, huge, massive layoffs because nobody wanted to buy what you were making. And so hiring workers was tough, or there were furloughs. We just aren't really doing a lot of work. I was really worried about getting furloughed from William & Mary around this time. I didn't, and I'm very grateful for that. 2021, we saw employment recovering, rebounding, wages were rising. But then in the fall, we had something that people have started calling the Great Resignation, right? Just lots and lots and lots of quits, people quitting their jobs. And that was making it harder and harder to hire workers. The rebound has been continuing into this year, but we'll see some numbers about what that looks like. So that's how we got here. And then let's talk about, where we are in a bit. So what are some potential COVID effects on workers? Why would we see this shift of the supply curve to the left? Well, one is just a lot of schedule disruptions. It was really hard to hold down a job or be a reliable worker when daycare wasn't reliable, when schools weren't open. And hopefully that is gonna not be as big a deal going forward. I would at least hope. I am not a psychologist or a sociologist, but the more I look at the evidence from labor economics and get puzzled by things, the more I realize that there was some sort of, I would just call it collective trauma, individual trauma associated with COVID, but also just as a society, we've seen a lot of rough things, and that makes it really hard to get up and work in the morning. And I think that probably has something to do with willingness of workers to do the work that they have. There's some talk, again, I'm not a sociologist, I'm not an expert on these things, but priorities maybe being realigned somewhat, maybe associated with the trauma that was seen. And so people who got their identity from work, maybe a little bit less these days, and that's something to think about moving forward. And then another big idea is that the government programs and local charities were very supportive of people in some ways, which might have reduced the urgency to work, right? So if I get unemployment insurance benefits and that's paying the rent, then maybe I don't need to go quite as fast back to work. This is moderating, has gone away or is going away, and so probably isn't going to play a huge role going forward. Schedule disruptions, I'm hopeful as well. The other things I think we might have lingering effects of these days. So let's just look at some of the numbers. I see some questions coming in. That's a lot of fun. Where are we getting local? So the Bureau of Labor Statistics gives us some information on the unemployment rate, even in Williamsburg. And so I should say these are estimates. We don't know exactly who is working in Williamsburg and who's available to work in Williamsburg. And so these are estimates from Bureau of Labor Statistics. They don't do it perfectly for a variety of reasons we could talk about later, but they do as well as you can. And, early 2020, the unemployment rate in Williamsburg was about 4%, which is quite low. And then it, went up a lot, and then it's really been coming back down. And so we're in a normal, actually a good territory in December of last year in terms of the unemployment rate. And so this is the number of people who are unemployed. So they're looking for work and they're available to work, but they're not working, as a share of the people who are working or unemployed. And so this looks like we've really recovered, at least in terms of what workers want to do or people want to do. But if you look at the employment numbers in Williamsburg, before COVID, employment was about 6,500. So this is workers in the area. And that plummeted, of course, as we expected, and has rebounded some, but has not rebounded 100%. So we're not back to the number of jobs we had before. And so this looks different than the unemployment rate, because basically the difference is people not really wanting to work, not really being available right away to work. So we haven't recovered in terms of economic activity up back to this place. We're kind of sort of halfway. Some of this might be kind of seasonal. Maybe it'll come back up here. I'm hopeful, but I'm not really sure. And this is something good to think about. Cognizant that the Williamsburg numbers are maybe a little bit noisy because the numbers are so small and it's hard to make estimates for small areas. I also looked at James City County, which has more folks in it. This is the unemployment rate in James City County. Very, very similar dynamics as we saw for Williamsburg. And employment in James City County actually looks quite similar. Of course, the numbers, the scale is bigger, but we saw a really big plunge and coming about halfway back. And then York County as well. This is where my kids were born. It's Centera, right? So unemployment rate quite low, very, very low. And it's come back to its pre-recession levels. But then when you look at employment, hasn't quite bounced right back. So this looks like we're still looking back for some workers. And again, maybe some of it's seasonal, maybe it'll come back up in the summer, but I'm not really sure. I'm not a prophet. So we'll be watching that, and that'll be very helpful and interesting to see. So I wonder if answering some questions would be helpful. Is that all right, Yuri? Am I allowed to do that?
Yeah, please do.
All right, very good. So we have, okay, good. So Rick Overy says, inflation and labor market, aren't wage increases good inflation since they provide more buying power for workers and decrease the income disparity? I think that's a great point. And I think there are different perspectives on wage increases. Certainly I teach my students, and I believe very much that in the United States for the past 4 decades or so, we have seen a major stagnation of wages in pockets of labor markets. So especially men, but to some extent women and folks with relatively low education levels. So people with graduate degrees, wages have been rising really fast, and that's good for productivity, good for them, that's great. But if you don't go to college, wages have been very, very stagnant for the past 4 decades or so, and wage increases in that group of people, very good news in some sense about inequality and so forth. So I think there are good things, absolutely, and I would affirm that, Rick, about wage increases. However, sometimes we think about a wage price spiral, which can get out of control. So if price increases are baked into wage negotiations, wages are just automatically going up 5% a year, 6% a year, 8% a year in contract renegotiations with unions or something like that. That can put pressure on suppliers, business owners to raise their prices, and this can kind of spiral out of control, which has happened, not even in my lifetime, but it's popping here in the US, but So we're a little concerned that wages could lead to bad inflation, but in and of themselves, right, they're actually some good news there. So I agree with you. Do employers these days need to reveal pay scale for a position to encourage more quality applicants? That's a pay scale. I mean, you want to say that you pay a lot, that this is a well-paying job. Scale, if you mean how much other people at the job earn, or how much your wage might increase later on. I think that that could help. More information to show workers, potential workers, that this is a well-paying job that they're going to want to keep. I think that would be helpful. Need to reveal? I don't think you need to, but I think it would be probably a good thing for the workers. And then Ted asks, during the previous major inflation period, economics discussion would talk about the need to improve efficiency and GNP. Any applicability now? Yeah, I haven't seen a whole lot about efficiency. I don't think I have a whole lot to add to that. We're mostly concerned about expectations getting baked into price increases, and just trying to tamp down people's expectations. Since 1982 or so, people have just not expected inflation because we just don't see it. The Fed is doing a good job. And so we trust that inflation won't get out of hand. There's less trust in institutions now. When I talk to people about what the Federal Reserve does, a lot of people don't know. And so trust matters a lot, because just understanding the minute details of what the Fed actually does and what inflation means is a hard thing. Professionals struggle with this. So I think mostly it's about trust that it won't get out of hand, and hopefully we can maintain that or win it back some. So I want to talk about just one other idea related to worker shortages. Actually, I forgot. So I calculated some information from the JOLTS data set, so this Job Openings and Labor Turnover Survey. This is specific for Virginia. They don't have more specific ones, but I mentioned the Great Resignation before. And so we see, going back to 2000, when we started collecting these data, the quit rate in Virginia. So this is the number of quits per 100 workers, was sort of between 2 and 2.5 monthly for a while, and it really came down during the Great Recession. And this is something we were watching really carefully, because when workers quit their jobs, it's a sign of optimism that there's going to be something better. Maybe they've already got in hand, or maybe they're just more hopeful. And so when workers were not quitting their jobs much in the Great Recession, we thought, yeah, it's a recession. Things are bad. Workers are just hanging on to the jobs they know they're lucky to have. And as we recovered from the recession, in this era, quit rates were still low, and we knew we hadn't really arrived because people weren't quitting their jobs. We wanted to see more people quit their jobs, and more people did eventually quit their jobs. But now a lot of people are quitting their jobs last fall, and that's something that is kind of surprising. So there are a lot of jobs available, I guess, but is this too much? Is this making it too hard to hire folks? Have priorities been realigned? This is the picture that motivated me talking about that a little bit. These are job openings, and they have really come up in Virginia very, very fast. And so if you've been trying to hire workers, I think you've noticed this. There's this last 2 months, they've kind of come down just a little bit from their peak. And so maybe that's good news about the ability to hire. And this is just the hiring rate. So are you able to hire at all? And hiring is, elevated relative to where it's been for a while. So maybe that's decent news. People are able to hire. You just have to work at it. It's not super easy these days. So here's that last idea I just wanted to share while we have time. Efficiency wages is jargon for labor economists. And it's basically the idea that if you raise wages, your workers will become more productive. So usually when we think about this labor market model I shared with you, if you raise wages, workers might be happy and thankful, but a worker is just a worker and is going to work as hard as she's going to work, whether she's getting paid a lot or not a lot. But there are reasons to believe that when you pay workers more, they internalize that and respond to it. And that might offer some strategy, some good ideas. Because while a business owner is obviously reluctant to raise wages because it cuts into profits, maybe you can't afford to raise wages, and that's a very important consideration. Nevertheless, if you raise wages, maybe even above what workers can get elsewhere, this is a real symbol of the value of your relationship with your workers, and they might be grateful for that and pay you back by sticking around. They might stick around because they like being here more, because they're earning more, and because this is better than their alternatives. If they go down the street to another job, they're going to get paid less. Well, they don't want to go down the street. And they might actually increase their effort because they know that this is a job they really don't want to lose. And so wage raises, Rick said, is this good because it reduces inflation? I'm sorry, inequality and things like that. Absolutely. But some wage increases, even maybe getting ahead of other people raising wages, might be a helpful idea for thinking about running a business. Now, of course, there are costs associated. You might not be able to afford it, cutting into profits, but this is an interesting idea that has some real empirical merit, I think, in labor economics, that raising wages can influence how your workers think about their jobs and how much effort they put forth. So those are the things I wanted to share with you. I think we're doing okay with time. Questions are welcome. I'm so happy we had questions in the middle, and yeah, I don't see anything else in the chat. So maybe I'll turn it over to Yuri, or if anybody wants to add something in the chat, feel free. Unless I've talked too much, I don't know.
No, it was perfect, Peter. Thank you. That was very helpful. I think it gave a lot of really good insights to the impacts of inflation and a lot of great insight on the labor markets and kind of what we can expect even here locally at Williamsburg. So really appreciate that. Does anyone have any additional questions?
Adria, I am not seeing anything more pop up in the chat box.
Okay. Well, without those questions, we'll go on and switch to the EDA minute from Yuri.
Fantastic. Thank you so much, Adrian. Thank you, Peter, for that presentation. I think you provided a lot of really relevant talking points for our business community, so we appreciate that. For my EDA minute, just wanted to put these next two roundtables on everyone's radar. Next month, we'll be hearing from Doug Smith, who is the CEO of the Hampton Roads Alliance. As you may know, Williamsburg, York County, and James City County recently rejoined the Alliance, so we'll be getting to hear a bit from their CEO about what programming and resources they have for our business community. And then on Thursday, May 12th, we'll be getting a Tourism Council update from the CEO of the Williamsburg Tourism Council, Vicki Simoneau. Just a quick note about, everyone knows usually these are on the second Tuesday of the month. The May 12th one has been moved to Thursday to accommodate the speaker's schedule. The last thing I wanted to note, we've been doing these roundtables virtually for the entire pandemic, pretty much since March 2020. And so we're sort of trying to figure out now what the path forward is, whether attendees want a virtual event, whether they want to go back to in-person, if you want a hybrid event. So we would like to move forward with what this audience wants. So keep an eye out in the next week. We'll be sending a very short 4-question. It took me 90 seconds to complete it, so see if you can beat my record. But just to give us some information about what you're wanting. And with that, I think that's all I've got.
Thank you, Yuri. And thanks everyone for joining today. I hope everyone makes it a great day to do business in Williamsburg, and please be on the lookout for that survey because we really do appreciate the feedback and how we move forward with the way we conduct these business roundtables, and hope everyone has a great Tuesday.
Wonderful. Thanks everyone, and thank you again, Peter.
You're welcome. Thank you. It's a pleasure.